The stock market is filled with opportunity, but only a few traders manage to truly master it. Have you ever wondered what these top traders know that the rest don't? In today's video, we're going to dive deep into the top 10 secrets of the most successful stock traders. From strategies and risk management to mental resilience and understanding market psychology, these secrets are the backbone of their success. Stick around until the end because the last tip is a game-changing mindset shift that can transform your trading approach entirely. First up, the trading plan. Successful traders never trade on impulse. They always have a well-defined trading plan. A trading plan is their roadmap and safety net, allowing them to make calculated decisions no matter what the market throws their way. Here's what goes into an effective trading plan. Goals and objectives. Successful traders start by setting clear goals. Whether it's income generation, capital growth, or building wealth for retirement, defining goals helps create focus. They set both short-term and long-term targets, breaking down exactly what they want to achieve and the steps to get there. Trading strategy. Their plan includes a trading strategy that matches their style and goals. For example, day traders have different strategies than swing traders. They outline their preferred technical indicators, like moving averages, RSI, or MACD, chart patterns they look for, and key market signals. Entry and exit rules. Pro traders outline precise conditions for entering and exiting trades. They use technical indicators, chart patterns, or news events to determine when to buy or sell. Having specific criteria for entries and exits removes guesswork and impulsiveness, allowing them to execute trades confidently. Risk management guidelines. In a trading plan, they define maximum risk per trade, such as risking no more than 1 to 2% of their capital. They also determine position sizing and where to place stop-loss orders to prevent substantial losses. Review and improvement. Experienced traders treat their trading plan as a living document. They review it regularly, update it with new strategies, and learn from both wins and losses. This disciplined approach helps them consistently refine their edge in the market. Secret 2. They focus on risk management. In the stock market, protecting your capital is just as important as making profits. Successful traders make risk management their top priority. Here's how they manage risk effectively. Position sizing. Traders allocate only a small portion of their capital to each trade, typically between 1 to 3%. This means no single trade can destroy their portfolio, even if it goes badly. Stop-loss orders. Pro traders set stop-loss orders to protect against major losses. For instance, if a stock drops below a certain price, the stop-loss order automatically sells the position. This prevents emotions from causing them to hold onto a losing trade. Risk-reward ratio. They calculate the potential risk versus reward of each trade, often aiming for a 1 to 3 ratio. This means they aim to make 3 times the amount they risk. Even if they win only half of their trades, the rewards from their winners cover the losses from their losers, protecting against drawdowns. Top traders protect their portfolio by having drawdown limits. If they lose a certain percentage within a month, they take a break to reassess. This keeps them from trading in a slump and protects their mental capital. Hedging strategies. In some cases, they use hedging strategies, like buying put options, to offset potential losses in a particular stock or sector. This is an advanced strategy, but can effectively balance out market exposure. Secret 3. They keep emotions in check. Emotional control is critical in stock trading. Markets can be volatile, and successful traders know that emotions like greed and fear can lead to costly mistakes. Here's how they stay grounded. Mindset of detachment. Successful traders treat trades as just numbers, not money. They focus on percentages rather than dollar values, which helps them avoid emotional attachments. Routines and consistency. They establish daily routines to keep themselves focused and consistent. Whether it's morning analysis or post-trade reviews, routines create structure and prevent impulsive behavior. Practicing mindfulness. Some traders practice mindfulness or meditation to stay calm and centered. This helps them stay present and avoid reacting to sudden market shifts with fear or excitement. Discipline in following rules. They stick to their rules no matter how strong the temptation. This disciplined approach keeps them from chasing trades, doubling down, or trying to recover losses emotionally. Taking breaks. During volatile markets, they sometimes step away from the screen, especially if they're feeling stressed. This break helps them clear their mind and approach trading with a fresh perspective. Secret 4. They diversify their portfolio. Diversification is key for managing risk in any portfolio. By spreading investments across various assets, successful traders protect themselves from losses in any single stock or sector. Here's how they achieve it. Industry and sector balance. A diversified portfolio includes stocks from different sectors, like tech, healthcare, and finance. This way, if one sector underperforms, the others provide balance. Asset variety. Diversification goes beyond stocks. They invest in bonds, commodities, ETFs, and even real estate investment trusts, REITs. Different asset classes perform differently in various market conditions, offering stability. Global investments. Many traders invest globally, giving them exposure to different economic cycles and reducing risk from one country's economic troubles. Risk profiling. They understand the risk levels of each investment and balance high-risk, high-reward stocks with safer, stable assets. Regular portfolio rebalancing. Over time, certain investments may outperform others, changing the balance of the portfolio. Pros rebalance their portfolio periodically to maintain their ideal allocation and reduce concentrated risk. Secret 5. They stay updated on market news. Market news can change the direction of stocks in a matter of minutes, and successful traders stay on top of these developments. Here's what they pay attention to. Economic reports. Indicators like unemployment data, GDP growth, and inflation affect market sentiment. They analyze these reports to anticipate market movements. Earnings announcements. Each quarter, companies release earnings, and the results can drive stock prices significantly. Pros keep track of upcoming earnings dates for stocks they hold or follow. Geopolitical events. Elections, trade deals, and international tensions impact markets globally. Being aware of these events helps traders make informed decisions and anticipate volatility. Sector-specific developments. They follow news relevant to specific sectors. For example, healthcare investors keep track of regulatory changes, while tech investors follow industry innovations. Following expert analysis. Successful traders often read insights from market analysts, economists, and fund managers to gain new perspectives. While they don't blindly follow others, they stay informed by analyzing different viewpoints. Secret 6. They practice patience and discipline. Patience and discipline are essential virtues in trading. Successful traders don't trade every day. They wait for high-quality setups. Here's how they manage it. Waiting for the right entry points. They don't jump on every movement. Instead, they have criteria for the exact entry point they're waiting for, sometimes letting dozens of opportunities go by to wait for the ideal setup. Avoiding the fear of missing out. FOMO. They understand that missing a trade is better than taking a bad one. FOMO leads to impulsive decisions, but pros stay patient, trusting that the market always offers new opportunities. Setting goals and limits. They set clear daily, weekly, and monthly goals. This gives them the discipline to stop trading when they reach their goals, preventing overtrading. Sticking to a routine. Daily routines keep them focused, helping to avoid impulsive trades. This routine includes research, analysis, and even short breaks to stay balanced. Planning each trade. Before entering any trade, they review the reasons, strategy, and expected outcomes, making sure they have a complete plan and that the trade aligns with their overall goals. Secret 7. They limit overtrading. Overtrading is a common pitfall for new traders, but successful traders know when to trade and, more importantly, when to wait. Here's why limiting trades is crucial. Avoiding high costs. Each trade comes with transaction fees, so trading too frequently eats into profits. Pros make fewer, higher quality trades to minimize costs. Reducing emotional fatigue. Overtrading can lead to mental exhaustion and impulsive decisions. By limiting trades, they stay sharp and focused. Avoiding impulse trades. Overtrading often leads to snap decisions with little analysis. Pros are selective, focusing only on trades that meet their criteria. Consistent profitability. By focusing on quality rather than quantity, successful traders achieve more consistent results, reducing the risk of substantial losses from unnecessary trades. Secret 8. They learn from every trade. Professional traders see every trade as a chance to learn, even if it doesn't result in profit. Instead of moving on quickly, they carefully review their trades and ask themselves important questions. Here's their approach to continuous learning. Keeping a trading journal. Top traders maintain a detailed trading journal where they record every trade, noting their reasoning, strategy, and the outcome. For each trade, they jot down the stock name, entry and exit points, position size, technical indicators used, and any relevant market conditions. This detailed documentation allows them to see patterns and improve decision-making. Reviewing trades regularly. At the end of each week or month, successful traders review their journal entries. They identify both winning patterns and mistakes, using this analysis to refine their strategy. By finding recurring errors, they avoid repeating the same mistakes. Analyzing winning trades. It's not only losses that teach valuable lessons. Analyzing winning trades reveals what went well, helping traders identify repeatable strategies. They look at what specific indicators, timing, or entry points made the trade successful. Calculating success rates and profitability. Pro traders often calculate the success rate of specific strategies or setups, allowing them to focus on what's consistently profitable. This data-driven approach boosts confidence in strategies with higher winning percentages. Setting improvement goals. Based on their analysis, they set actionable goals, such as reduce impulsive trades or improve exit timing. They focus on one area at a time, creating measurable goals that foster long-term improvement. Secret 9. They understand technical and fundamental analysis. Successful traders know the importance of using both technical and fundamental analysis to make well-informed trading decisions. Each analysis method provides unique insights. Here's how they leverage both. Technical analysis for market timing. Technical analysis helps traders identify the right moment to enter or exit a trade. They study charts, trends, volume indicators, moving averages, and more to understand market momentum and spot entry points. Tools like RSI, Relative Strength Index, help determine if a stock is overbought or oversold, guiding decisions on when to buy or sell. Fundamental analysis for value assessment. Fundamental analysis is all about assessing a company's value. Traders dive into financial reports, analyzing revenue, earnings growth, profit margins, and debt levels. They compare these with industry averages to determine if a stock is undervalued or overvalued, which informs their decision to buy or hold for the long term. Combining both for strategic precision. Many successful traders use fundamental analysis to pick strong stocks and then rely on technical analysis to time their trades effectively. For instance, they may identify a strong company using fundamental analysis and then look at chart patterns to decide the best time to enter. flexibility with tools and indicators. They don't rely on a single indicator or method. Instead, they use multiple tools and indicators to confirm trends and increase confidence in their decisions. They might pair moving averages with trend lines and Fibonacci retracement levels for a comprehensive view. Continuous skill development. Top traders stay updated with the latest in technical and fundamental analysis techniques. They read industry research, study new indicators, and attend training sessions, constantly updating their toolkit to stay competitive in evolving markets. Secret 10. They adapt to changing markets. The stock market is dynamic, with ever-changing trends and external factors influencing price movements. Successful traders know that being adaptable is essential to staying profitable. Here's how they approach adaptability. Monitoring market sentiment. Pro traders keep a close eye on market sentiment, whether it's bullish, bearish, or neutral. This allows them to shift strategies based on the prevailing sentiment. In a bullish market, they might go long on growth stocks, while in a bearish market, they may switch to defensive or value stocks. Adjusting to market cycles. Markets tend to follow cycles such as expansion, peak, contraction, and trough. Pros understand these cycles and adjust their portfolios to match the phase. For example, during an economic downturn, they may shift toward recession-resistant sectors like utilities or healthcare, knowing when to hold cash. In particularly volatile or uncertain times, they may choose to hold cash rather than being fully invested. By reducing exposure, they avoid significant losses and preserve capital for better opportunities. Holding cash also gives them the flexibility to buy stocks at a discount when the market stabilizes. Sector rotation strategies. Sector rotation is a technique where traders shift their focus to different sectors depending on economic indicators and market conditions. They might shift into cyclical sectors like consumer discretionary in good times and defensive sectors like consumer staples during downturns. Constantly updating knowledge. To stay adaptable, pros consistently learn about emerging trends and technologies that could impact their investments. They research new industries, study alternative markets, and adapt to innovations, allowing them to pivot quickly when necessary. If you found these secrets insightful and you're ready to apply them to your own trading, make sure to give this video a thumbs up. Subscribe to the channel and turn on notifications so you never miss our latest trading tips. And share this video with someone who could benefit from these insights. Who knows? You might just help them take their trading to the next level.